Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me back.
So, let's set the stage here. Imagine you need to send, say, $1,000 to your family overseas, maybe in the Philippines,
Right.
and it is Sunday at 2 in the morning. Now, if you use your traditional bank, they are going to charge you, up to $80 in just random fees.
Oh, yeah, easily.
And the money will not actually even arrive until maybe Thursday. But right now, running quietly in the background of the internet, there is this whole parallel financial system.
A completely different set of plumbing.
Exactly. And it will move that exact $1,000 in about 3 seconds for less than a single penny. So today we are taking a deep dive into stablecoins.
And it's a subject that honestly desperately needs clarifying. Because the word coin, it instantly gives people the wrong impression.
Yeah, I will admit I am totally one of those people. You know, when you say crypto to the average American, our minds immediately jump to just wild speculation.
Dog-themed tokens, right?
Right. We picture the meme coins, massive overnight price crashes, and, 20-year-olds either getting insanely rich or losing everything they own.
Which is the narrative we've seen for a decade.
But our mission for this deep dive is to really understand that stablecoins are something completely different. I mean, if Bitcoin is this highly volatile tech stock, stablecoins are basically just the softwareization of the plain old U.S. dollar.
I like that framing. Softwareization.
Yeah, and we are going to look at how these digital dollars are quietly rebuilding the global financial plumbing and why the real investment opportunity is not actually in buying the coins themselves, but in the massive corporations building the infrastructure around them.
What's fascinating here is that distinction. It is the absolute foundation of everything we are going to discuss today. Because you are not buying a stablecoin expecting it to double in value. The price is mathematically and structurally designed to stay at exactly $1. Always.
So let's just set a baseline for you listening at home, just in case you're entirely new to this whole space. Think of a stablecoin like a digital casino chip or maybe an electronic gift card balance.
Yeah, that works.
But instead of being locked to one specific department store or one single casino floor, it is pegged to the US dollar and you can send it anywhere in the world instantly using the internet.
Just moving data.
Exactly. And this is not just some niche Silicon Valley experiment anymore either. I was looking at some recent data, specifically an analysis from the World Economic Forum published in February 2026, and the global stablecoin market cap has hit around $300 billion.
$300 billion. And the most significant shift in that data really is what that $300 billion is actually doing now.
What do you mean?
Well, if you rewind to the early 2020s, stablecoins were primarily just utility tools for crypto day traders.
Like a holding area.
Exactly. If someone wanted to sell their Bitcoin, but they didn't want to endure the hassle of cashing all the way out to their traditional bank account, they simply parked their money in a stablecoin.
Oh, I see.
It acted as a digital waiting room. But the current numbers show they have completely evolved from a trader's waiting room into the actual underlying settlement infrastructure for everyday real-world businesses.
Okay, let's unpack this because I want to stop you right there and push back on that idea a little bit.
Sure.
Because I was looking at some recent analysis that presents this massive contradiction.
Okay, let's hear it.
So on one hand, we have this $300 billion market cap. But according to a February 2026 analysis by McKinsey & Company, the actual real-world use of stablecoins, meaning B2B payments, buying goods, remittances, is about $390 billion annualized.
Which is a very substantial amount of economic activity.
It sounds massive on the surface. $390 billion is a huge number, but that same analysis points out that this represents only about 0.02% of all global payments.
Yeah.
0.02%. So I just have to ask, if this technology is supposedly the ultimate upgrade to our financial plumbing, why is it mathematically just a rounding error in the global economy right now?
No, that is a completely fair skepticism. It really is. To understand that contradiction, you have to separate the signal from the noise on the blockchain.
The noise.
Right. When you see astronomical numbers reported for stablecoin transfer volumes, numbers often reaching into the trillions of dollars, a massive portion of that is just automated noise.
Like bots.
Exactly. It is algorithmic bot trading. It's transfers moving back and forth between different corporate crypto exchanges.
Oh, wow.
Yeah, and automated systems just shuffling funds between their own internal digital wallets. So when you strip all of that artificial volume away and look purely at economic utility, meaning a human being actually buying a service or sending money home, you are left with that 0.02% figure.
So despite all the hype, I mean, it is still very much in its infancy when it comes to actual global commerce.
It is,
Yeah.
but you really have to look at the trajectory here rather than just taking a current snapshot.
Okay.
Bloomberg Intelligence ran some long-term projections based on the current adoption rates.
Yeah.
And they estimate that stablecoin payment flows could hit $56.6 trillion by 2030.
Wait, 56 trillion?
Yes. That is a scenario where stablecoins are no longer a niche tool. They are directly competing with legacy giants like Visa, Mastercard, and the SWIFT International Banking Network.
But getting from 0.02% to $56 trillion in just 4 years seems, I mean, almost impossibly steep.
It is incredibly steep, which is exactly why the underlying mechanism of adoption is so important.
Right.
To compete with Visa, the stablecoin industry cannot just rely on having superior or faster tech. That's not enough.
What do they need?
They require aggressive regulatory approval, strict consumer protection frameworks, and incredibly complex integration with the very legacy banking systems they are trying to disrupt.
Oh, so they have to work with the old system to beat it?
Precisely.
Mm.
Building those bridges takes time, but that integration is happening at breakneck speed right now.
So if the infrastructure is still being built here in the West, I want to pivot to where this technology is actually generating that $390 billion in real-world volume today.
The emerging markets.
Yeah, because if you are living in the U.S., you probably just use Venmo or Zelle to pay your friends, and you think, well, the financial system works just fine.
It's invisible to us.
Exactly, but cross-border payments are a completely different reality.
Cross-border finance has historically been one of the most painful, expensive, and frankly opaque processes in the global economy.
And based on the research we reviewed, the primary place where stablecoins are just exploding in real-world utility right now is in cross-border remittances. Heavily focused on Asian markets, specifically places like the Philippines, India, and Vietnam.
That's where the real pain points are.
Let me try an everyday analogy to explain how this actually works mechanically, because I think people get really lost in the tech jargon here. Let's think about this like making a sandwich.
A sandwich. Okay, walk me through the mechanics of this sandwich.
Okay, so imagine an overseas worker in the U.S. sending money home to the Philippines. In the traditional banking system, that money has to be physically routed through multiple intermediary banks. It stops at a clearinghouse in New York, waits for approval, gets routed to an international correspondent bank, crosses the ocean, lands in a central bank in Manila, and finally trickles down to the local branch.
Which takes days.
Days. And every single bank along that route takes a bite of the sandwich, a toll fee. It can cost up to 8% of the total money being sent.
And the sender has zero visibility into where the money even is while it is in transit.
Right. But with the stablecoin method, it is a totally different sandwich. The user just opens a local financial app on their phone. They put their local US dollars in. That's the first slice of bread.
Okay, I follow.
Behind the scenes, the app's software automatically converts those dollars into a digital stablecoin to instantly cross the border for fractions of a penny. That's the meat of the sandwich, the actual transit.
The efficient part.
Exactly. There are no correspondent banks taking bites out of it. And on the other side, the receiving app instantly converts that data back into Philippine pesos, the second sliced bread, and the family can withdraw it immediately.
The crucial element there is that the end user does not even need to know what a blockchain is or what a stablecoin is.
They just see the money move.
Exactly. They just see that they pressed a button, the money vanished from their U.S. phone, and appeared instantly on their family's phone in Manila.
And looking at the data, this new sandwich routing drops the fees from that painful 8% down to 0.5% or less.
Which is massive.
For a family relying on small amounts of money sent home every single week, getting back 7.5% of their income is completely life-changing.
It alters the entire economic reality of those communities. And this brings up an insight that Chainalysis published recently in April 2026.
What did they find?
They projected that stablecoin payments could rival Visa and Mastercard's off-chain volume between 2031 and 2039.
Wait, hold on. Off-chain volume sounds like a bunch of industry jargon. Are you just talking about standard credit card swipes at a grocery store?
Yes, exactly.
Yeah.
Off-chain just means traditional transactions processed on Visa's private closed network rather than on a public blockchain.
Okay, got it.
Chainalysis is saying that within a decade, People might be moving as much money via stablecoins as they do by swiping their traditional credit cards.
That is wild.
And the reason for this explosion in emerging markets is not about people wanting to trade crypto. It is about basic, fundamental access to the US dollar.
Because their local currency is failing.
Exactly. In many developing nations, local fiat currencies suffer from massive inflation or volatility. Getting a traditional sanctioned US dollar bank account is nearly impossible for the average citizen in those countries.
So what do they do?
Stablecoins are effectively acting as shadow digital dollar accounts for the unbanked populations of the world. It is the democratization of the dollar.
Shadow digital dollar accounts. That is a really powerful phrase, but honestly, it raises a massive red flag for me.
How so?
I just cannot buy the idea that the U.S. government is happily stepping aside to let private tech companies mint their own dollars. I mean, the U.S. protects its monopoly on the dollar with the most powerful military and regulatory apparatus on Earth.
That's true.
So if tech CEOs are creating shadow banking systems globally, wouldn't the government just immediately want to crush this?
You would assume the government would see it as a direct threat to their sovereignty. You really would. But the actual policy response we are seeing is entirely counterintuitive.
Really?
Regulation is not shutting this down. Regulation is actively paving the road for it to expand.
I was actually reading up on the legislative history here, and based on the research, the U.S. has aggressively embraced it.
They have.
On July 18th, 2025, the U.S. government signed the Genius Act into law. And this established a really comprehensive framework for stablecoin reserves and the companies that issue them.
It was a landmark piece of legislation.
It laid out the exact rules for how you have to back these digital dollars so a company cannot just print them out of thin air. And then in March 2026, the Federal Reserve's Vice Chair for Supervision, Michael Barr, gave this big speech.
Right, I remember that.
He noted that while the law is a huge step, the real impact comes down to how federal and state regulators actively enforce these rules on the ground today.
If we connect this to the bigger picture, to understand why the U.S. took that approach, we really need to look at the global contrast.
Okay, let's zoom out.
We see a stark contrast when we look across the Atlantic to Europe. Let's look at recent news from just a couple of days ago, May 8, 2026.
What happened there?
European Central Bank President Christine Lagarde expressed deep fundamental skepticism about private euro stablecoins.
Oh, she's not a fan.
Not at all. She warned that allowing private tech companies to issue digital euros could severely disrupt the European Central Bank's ability to control monetary policy.
So they want to keep it in-house.
Exactly. She vastly prefers a system completely controlled by the central bank or heavily regulated tokenized deposits at traditional commercial banks.
Okay, so the U.S. government is basically saying, hey, let's set strict rules so the private sector can build this infrastructure, while Europe is saying we are terrified of losing control, so we do not want the private sector doing this at all.
That is the exact dynamic. Regulation in the U.S. is not a roadblock. It is a VIP pass.
A VIP pass. I like that.
Europe is trying to build a fortress to protect its central banking power. But the U.S. is using regulation to deliberately pull these private stablecoin issuers out of the shadows and directly into the regulated traditional banking system.
So they can keep an eye on them.
Yes. By passing the Genius Act, the U.S. government essentially told Wall Street and big tech, here are the rules of the game. If you follow them, you can legally operate.
And here's where it gets really interesting. Because the moment those rules became clear and that legal risk vanished, the traditional financial titans didn't just dip their toes into the space.
Oh, they kicked the door down.
They kicked the door down.
Yeah.
We are no longer talking about scrappy tech startups operating in some gray area. Looking at recent analysis, Mastercard acquired a massive stablecoin infrastructure company called BVNK for up to $1.8 billion in March 2026.
Huge acquisition.
And Stripe, which processes payments for basically half the internet, they acquired a company called Bridge in early 2025. And by May 2025, they had launched stablecoin accounts across 101 different countries.
It is a corporate land grab of historic proportions.
I look at this and it immediately makes me think of the railroad barons in the 19th century.
Oh, that's a great comparison.
Right. Visa and Mastercard are not sitting around blindly hoping these new stablecoin trains don't run them out of business. They are simply using their massive cash reserves to buy the new digital railroads, so they own the tracks entirely.
Exactly.
They know the future is digital dollars, and they want to ensure they are the ones collecting the tolls when those dollars move.
That railroad analogy is spot on. And it brings us back to the core mission of our discussion today. Where is the actual investment opportunity?
Right. Because it's not the coin.
The play is not buying a stablecoin. Buying a digital dollar just means you hold a dollar that doesn't grow. The real winners, the entities that will capture the immense value of this systemic shift, are the infrastructure providers.
The people owning the tracks.
The platforms, the custodians, the payment networks like Stripe or Mastercard.
And the asset managers, right. Because I saw that BlackRock, the biggest asset manager in the world, they started preparing tokenized money market funds for stablecoin holders as of May 2026.
Yes, BlackRock is a major player here.
Wait, can you translate tokenized money market funds into plain English for us? Because that sounds really complicated.
Certainly. So a money market fund is essentially a very safe investment that pays you yield, usually backed by government debt.
Okay, simple enough.
Tokenizing it just means BlackRock is taking that traditional, boring financial product and putting it on the blockchain.
So making it digital and fast.
Right. Imagine a standard savings account that pays you 5% interest based on U.S. Treasury bills. But instead of living in a bank's private, closed database that shuts down on weekends and holidays.
It lives on a public blockchain.
Exactly, where you can move that money globally 24 hours a day, 7 days a week.
So BlackRock and Stripe are essentially selling the pickaxes and shovels during a digital gold rush. They're managing the on-ramps and off-ramps.
They control the friction. And in financial services, whoever controls the friction controls the profit.
Okay, so we have covered the underlying technology, the massive adoption in Asian remittances, and the fact that Wall Street is basically buying up the infrastructure. I want to zoom out even further to the big macro picture here.
The geopolitical side.
Yeah. How does upgrading our financial plumbing actually affect the broader U.S. economy? And more importantly, how does it impact the everyday person listening to this right now?
To understand the macroeconomic impact, you have to look under the hood at how a stablecoin actually maintains its value.
Okay.
When a company issues $1 billion worth of stablecoins to the public, they do not just take your physical cash and lock 1 billion paper bills in a dark vault somewhere.
They don't. What do they do with it?
They take that cash and they buy highly secure, yield-bearing assets.
Wait, yield-bearing assets is another one of those Wall Street terms. You mean they're taking our cash and using it to earn interest for themselves?
Exactly. They take the cash you gave them, and they primarily buy short-term U.S. Treasury bills. They are lending your money to the U.S. government, and they pocket the interest.
Wow. Which provides massive context for the geopolitical angle. For everyone listening, let's frame this realistically regarding current events.
Sure.
Under the current Trump administration, maintaining strong U.S. dollar dominance and maximizing economic leverage globally is a clearly stated priority.
Absolutely.
So when the U.S. embraces stablecoins and allows tech companies to spread these digital dollars to the far corners of the globe, they are essentially creating a massive structural global demand for U.S. national debt.
It is a brilliant strategic maneuver for maintaining dollar hegemony.
It really is.
Because everyone, everywhere in the world wants to hold these digital dollars to escape their own local inflation. And every time they buy a digital dollar, it directly funds the U.S. government by purchasing a treasury bill.
That is wild to think about.
We are effectively exporting our national currency digitally, cementing U.S. financial supremacy against international competitors.
So we are basically using global demand for stable internet money to finance our own national debt. That is incredibly clever on a geopolitical scale, but, I mean, there has to be a catch. What is the domestic risk here?
Well, the domestic risk is significant, and it threatens the core of how local American communities function. A recent analysis from the Brookings Institute pointed out a very real systemic danger to local economies involving deposit flight.
Deposit flight. Walk me through that. If we are just digitizing the dollar, where is the harm to the local economy?
Look at your own checking account right now. Think about where your savings sit. Every day, Americans keep their money in a checking or savings account at a local or regional bank.
Sure, down the street.
That local bank takes your deposits and uses them to fund the community. They use your money to give out a mortgage to your neighbor so they can buy a house. Or they provide a small business loan to the local bakery.
Right, that is how money creation works locally. I follow you. The local bank needs my deposits to make local loans.
Now, imagine if everyday Americans realize they can instantly move their money out of those traditional bank accounts and into high-yield stablecoins, or into those tokenized money market funds that BlackRock is building.
Oh. I see the domino effect.
Exactly.
If I can get a 5% yield instantly on my phone using a digital dollar and I can spend it anywhere in the world, why would I leave my savings in a traditional checking account making 0.1% interest?
You wouldn't. And if that realization happens on a mass scale, smaller local and regional banks will suffer from massive deposit flight.
Just draining the banks.
Billions of dollars will drain out of community banks and flow into these tech-driven digital dollar platforms. If local banks lose their deposit base, they literally do not have the capital to lend.
Wow.
If they cannot lend, your neighbor cannot get a mortgage, and the local bakery cannot expand. Local economic growth skulls completely.
That is a terrifying trade-off. We win on the global stage by digitizing our currency and exporting our debt, but we inadvertently hollow out the deposit base of the community bank down the street on Main Street America.
It is the ultimate double-edged sword of financial innovation. The technology solved the friction, but the friction was historically what kept local money inside local communities.
So what does this all mean? Let me try to wrap this up for everyone listening and distill it down.
Okay.
If you've been hearing about stablecoins over the last few years, and assuming it is just another chaotic crypto casino, it is time to erase that from your mind entirely.
It's a new era.
Stablecoins are the new software running the global US dollar. They are cutting the cost of sending money around the world from an agonizing 8% down to fractions of a penny. And because the US government has laid out clear, strategic rules with the Genius Act, the biggest financial titans in the world, Mastercard, Stripe, BlackRock, are spending billions to buy up the infrastructure.
Which is where the real value is.
Exactly. The biggest opportunities here do not lie in holding the digital coins themselves, but in the regulated, compliant companies building the toll roads, the payment networks, and the reserve management systems.
That captures the reality perfectly. It is a massive structural infrastructure play. And as we watch this space mature over the next few years, I will leave you with a final provocative thought to mull over.
Let's hear it.
If a massive tech company can offer you a seamless digital dollar account on your smartphone that sends money globally for pennies, and a giant asset manager gives you direct, frictionless access to high treasury yields on that exact same money, how long until you stop needing your traditional checking account entirely?
Wow. That is a question every local bank executive is probably losing sleep over right now, and is a financial shift that you and I will all have to navigate much sooner than we think. Don't forget to subscribe and hit that like button.